Hey everyone, we are live. Wednesday afternoon, we're going to hang out, talk about financial planning topics, tell you what I'm seeing this week, and then what are you seeing this week? Chime in the chat, and we'll talk about it and maybe do some Q&A. So at Barrett FP this week, the big thing that I've been watching is the One Big Beautiful Bill. So this is the name of the tax legislation currently working its way through Congress. Yeah, I believe it's in the Ways and Means Committee at the moment. And once it comes out of that committee, I believe it will be assigned a bill number, but I haven't actually been able to find a bill number as of yet. I call it the Big Beautiful Bill because that's literally what it's called. If you go and look at the House of Representatives website on the front page of this draft legislation, that's what it's called. Literally last week, I was at a continuing education seminar in person, and the lawyer who was presenting said this language, and I thought he was just making a political joke, but it turns out that he wasn't joking. That's literally what they're calling it in Washington. So we'll talk about what's in there that's relevant for our financial planning, or some of the things that I think are most relevant. And then we'll also talk about some frustrations with Monte Carlo analysis that I've been thinking about, and then whatever else everyone wants to talk about. So the Big Beautiful Bill. Last week, this draft came out. So it's a 300 and it's close to 400 pages of draft legislation. So people have been digesting it. Some of the things that I think are most important. So before we get into this, so disclaimer, this bill has got a long way to go. Like I said, it's not even technically in the House yet, and it's got to get out of the House and then approved by both chambers, and then signed by the president. So we're going to be seeing a lot of this over the summer, I have a feeling. So nothing to do at the moment. So key items. So number one is the estate planning, the gift tax exemption. At the end of 2024, as the current law states from the TCGA that was passed back in 2017, it's going to go from 14 million per person down to 7 million. So meaning if you have a $14 million estate this year, and if you die in next year in 2026, and they don't get this legislation passed, your estate's going to owe estate tax on that difference between your gross estate and the exemption amount, which is slated to go back to 7 million. So what this is stating is they're going to increase that up to around 15 million. And then it's not going to go back to revert back to 2016 and before then. So that could nullify a lot of planning that's been done. There's been a lot of people that have been in this category that have done some planning around taking advantage of that exemption amount by gifting assets earlier than they might have normally. So, when Republicans are in control of the House and the Senate and the presidency, I think a lot of people have been expecting this change, but still, it'll be nice for those people to see that increase. It'll affect a lot of people relative to the entire country. It's a very small number of people, but a lot of people in an absolute sense. Probably relevant for a larger percentage of the country is the SALT cap deduction increase. So it's proposed to go from the current cap of $10,000 to $30,000. So there are phase outs that come along with that, though. So if you're married filing jointly, it would start to phase out over 400,000 of modified adjusted gross income. So between 4 and 500,000, you still get the increased cap amount, but once you're beyond 500,000, you're basically back to where you are this year at a $10,000 cap. But that could be, this has been very impactful for people in high tax states, and even for people in non-high tax states. If you have property taxes, for instance, that are a little bit higher, and you have a more valuable piece of property, you can hit that $10,000 limit very quickly. So a lot of people are going to be very excited to see that come back, and we'll hope that one makes its way through. Oh, another note on that is there are a lot of strategies around pass-through entity tax, or PTET. That's state specific, and it's pretty involved work that you have to do with your CPA involving elections with your state. If you're a business if you own a pass-through entity, you can, in some states, make an election where your entity actually pays certain taxes so that you can deduct more, and it's kind of a way to circumvent this $10,000 cap. So didn't see any references to those strategies being impacted, but that will be very relevant for a lot of people who do that because it's a very valuable thing that is available to them. In that same vein, QBI deductions changing quite a bit. So again, if you own a pass-through entity business, you are likely taking advantage of QBI. This is where you can deduct up to 20% of your qualified business income off of your return. So the first change is they're going to make this permanent. So going from the 10-year to this is always going to be around. And the second thing is they're going to increase the rate. So right now you can deduct 20%. They're actually going to move that to 23% with this draft proposal. And it kind of simplifies the QBI a little bit. So right now, if you're under the phase out limits, it's pretty simple. You got to take your 20% and that's that. But once you get above those limits, it gets pretty complicated pretty quickly. So for people that own professional services business, so think doctors, lawyers, accountants, if you hit over that limit, you don't get the deduction. So that is, people will probably try really hard to stay under it. If you own a different type of business that is not one of those ones that I mentioned, then there is this super complicated formula that involves the wages you take out of the business and a percentage of qualified assets that the business owns. And if you add that up, the percentage that you get to deduct is probably not as close to 20% as you would like. So it's going to simplify that process and then also potentially remove some of those restrictions for professional service providers, which would be good for financial advisors too. So other things that are getting a lot of attention, I didn't dive into them as much yet, but bonus depreciation potentially coming back to up to 100%. In 2025, it's 40% right now. So that could be a huge deal for a lot of business owners, especially real estate investors, involving depreciating certain parts of the property at an accelerated rate. Of course, that depreciation down the road, you might have to do some recapture there. But a lot of people are very excited about bonus depreciation potentially coming back. And then also some opportunities with certain developments in opportunity zones. So something to watch out for there. But yeah, those were some of the things that I picked out that probably most relevant for a financial planning type of discussion. So we're going to be hearing a lot about this summer, and it's just early days yet for this. So be sure to keep our eyes peeled and keep everyone updated on this. So I did want to also touch on switching gears a little bit to other financial planning topics. This thought around Monte Carlo analysis, I think there's a big problem with it. And it comes up, we're coming out of a period of time where we've had a pretty steep and quick drawdown in the markets with that trade war and Liberation Day at the beginning of April. Now equity markets have risen again, so we're kind of back to where we were before. But I think a lot of people have probably experienced this, where your portfolio declines a meaningful percentage, and it also impacts your percentage chance of success in your Monte Carlo analysis, seemingly overnight, and with no change other than, hey, my asset value just went down. So what gives? I think it's very important to recognize that this is going to happen and what are some things that are going to mitigate it. So the Monte Carlo analysis, a lot of advisors will refer to it as kind of like a stress test on your portfolio. So basically, it's going to take a look at what are your assets today, what are you expected to earn over your retirement period, what are you expected to withdraw over your retirement period, and then it's going to take those cash flows and then apply returns to it. So it'll be returns, and it'll do that thousands of times. And in the end, it's going to aggregate a list of all the times that your plan was successful, meaning you made it to the end of your plan dying without running out of money, and all the times that you ran out of money. That would be an unsuccessful trial, if you want to be a statistician about it. So it includes the returns that it applies. It's based on some distribution of returns that have happened in the past. So if you run 3,000 simulations, you're probably going to get return streams that are very similar, if not identical, to what we've seen in history, but then a lot that haven't happened and are better and or worse than what we've seen in the past. So people say that the reason to do this is a little bit more robust way to look at your portfolio and kind of avoid that trap of, well, the worst thing that can happen is equal or less than the worst thing that ever has happened before. I think people in finance can get in trouble with that, and you heard a lot of talk about that with the financial models that banks had leading up to the great financial crisis. So it didn't account for the appropriate amount of risk, especially in housing related investments. And when that risk showed up, no one was really expecting it. So that's the idea there is you want your retirement portfolio to be resilient enough to put things that potentially could happen, but we haven't seen before. But the problem is when we get these market events where your portfolio might be down 10%, it impacts that probability of success number materially. And it can leave you feeling quite stressed out and worried. And I think the answer to that would be, well, your assets declined in value. We did plan for that, right? Because there was a scenario in which it did follow that path, right? If we had thousands of paths, there would have been one that tracked. But you're not still at your percentage chance of success. You're lower than that. So say you were targeting 80 or 85% chance of success. Now you're in the 70s or maybe even in the 60s. The argument would be, well, now that your assets are worth less, not worthless, but worth less than they were, your expected returns going forward are probably increased a little bit. So that should make up for the decline. That's pretty unsatisfying to me. I mean, you can't change it in real time like that, and who's to say, who's really going to make that determination at the end of the day? So I'm curious if there's anyone out there that has run into that. How do you think about dealing with that in looking at your portfolio and seeing that number change? Or if you've worked with clients before and that's happened and that's come up, what are some of the things that you talk about with them at that point? So I think Monte Carlo analysis, it is important in the process, but it shouldn't be the number one and the only thing that you're looking at to determine if you're on the right path, because I think that number is going to move around so much with the market that you are likely going to be emotionally going to, just move with that number. So yeah, let me know. Yeah, what are some people use guardrails? Some people just look at cash flow to try and insulate themselves from that level of potential pain if you feel that way. But it definitely happens to everyone. I mean, the markets, they do almost every year experience declines of 10% or more. So it's going to happen to everyone at some point, pretty much. So it is something to be aware of and just think about how you're going to work through that when that time shows up. Yeah. So with that, looks like we don't have any questions here in the chat. So yeah, I guess just other updates on Barrett FP, officially state registered, which is very exciting. So we're going to begin these marketing efforts and beginning to take on clients and work to deliver hourly financial plans and work in that manner with clients. So very excited about that and looking forward to connecting with everyone, and keep hanging out on Wednesdays. I'm going to post videos on YouTube. The website is live. There's still a little bit of work to do yet on the website, but we're going to get all that figured out. And yeah, we'll see you guys later. All right. Take care.